Hey traders, today is Wednesday, January 28th, and I'm Michael Boutros, Senior Market Analyst with StoneX here for a quick multi-time frame look at the US dollar. It is Fed Day, and the dollar has been taking it on the chin. We're more than 3.9% off the January high for a second consecutive weekly decline, taking a little bit of a breather here right ahead of the Fed rate decision later today. Some implications on this break. We've now broken below the 2025 swing lows, the close lows, and certainly leaves some technical damage in the wake here as we head into that Fed rate decision. Some things to keep in mind. Last year's low was 96.21. Watch this week's close with regards to that level. Below that level, there's really nothing that comes into focus from a technical standpoint until you get down just below 95. 94.97 is going to be the 100% extension, two equal legs off that entire 2022 decline. And you got the 786 retracement of the advance off the late 2020 ascent, and that converges on that March 2020 low. All of that gives you 94.65, 94.92 as sort of the next main pivot zone from a weekly standpoint. Now, if you drill down a little bit deeper to the daily charts, here's what it looks like. Yesterday's decline was the largest single day decline since August of last year. We all remember that. Big reversal came right off resistance and was the start of a multi-week, multi-month downtrend into the yearly lows. It was the largest single range on a daily basis since back here in April of last year. And that was right in the midst of the decline that we saw in the DXY. So rate of change, largest daily range, all executing yesterday with the FOMC on tap later today. So some near-term levels to keep in mind. The July low, again, last year's low, 96.21, extends into 96.38. That's going to be just the swing lows from July. So a nice pivot zone there. A basic 38.2 of just this month's range gives you 97 proper. The 2025 low day close, the day that the low is registered for the year, the close of that session is 97.01. Look for a reaction there if reached. A breach and a daily close above that would suggest, at least in the near term, an exhaustion low is in place and the potential for a recovery. But below that level, the technical damage might already be done. Initial targets on the downside, you do have the 1618 extension from the decline off the November highs. That comes in near 95.21. So just ahead of that larger zone we talked about in the weekly chart. 95.21 initial support, 94.97 stretches into 94.62. Here's what it looks like on the 4-hour chart. Been tracking this really acute descending formation. It's really a very tight formation, so I don't have too much convictions on it. But it highlights just that July low and that 2025 low as initial resistance. And again, the lower parallel converges on those downside targets we just discussed over the next few days. No expectation for a change from the Fed. Markets are still priced in for June to be the first rate cut from the Fed. You're about 64% chance that by June we'll get that initial rate cut, but all through April even, you're still looking at a 70% chance the Fed will hold. Now, the devil's going to be in the commentary today. In his last Fed rate decision, Powell specifically highlighted that the threat to the mandate was on both sides, meaning downside risk for the labor markets, upside risk for inflation. Since then, we've gotten some pretty decent reads on employment. Unemployment dropped to 4.4%. There was a miss on non-farm payrolls, but you're seeing labor force participation contract a little. Weekly jobless claims last week were better than expected, bringing down the 4-week average. So the key here is if Powell starts to stress the inflationary outlook as being the outlier or the larger of the two risks, that might further push out interest rate expectations, which might offer a short reprieve to the US dollar. So that's what I'll be looking for in the commentary. Obviously, there's a lot of things going on with geopolitical risks. You have escalating tensions with Iran. You have the government shutdown, which is pending. By the end of the week, it looks like we may, in fact, get a partial shutdown. And then again, obviously, the outlook for rates is shifting here, but it continues to be kicked out. So lots of things in the blender. We'll try to keep you updated, as always, on X at MB Forex. Till then, best of luck trading. We'll see you tomorrow. Cheers.